Welcome. This is Mary Ellen McGonagle with your Friday afternoon MEM Edge show. And of course, this is the show where we bring you where the action is in the broader markets. Another rocky period here as we wade through a lot in the way of economic and other news that's taking place. Let's take a look at the agenda today. As usual, we're going to take a look at the broader markets, see where did we close a lot in the way of red on our screens this week. So we'll see if we were able to hold support or not with those broader markets. Also take a look at some of the more impactful news that really dictated price action for the week. From there, we're going to take a look at preparing for earnings season. It does begin next week. This is going to be first quarter earnings. And I do also have a very special guest for the second half of our show, Danielle Shay. She is the VP of Options at Simpler Trading. So very excited about that. So let's take a look at those news headlines from last week. And certainly the most impactful was the Federal Reserve. There was a Fed governor on Tuesday who talked about Fed policy going forward and implied that the Fed was going to put the pedal to the metal, be aggressive in their stance to fight inflation. And that really caused a tipping point as it relates to growth versus value. So we'll get into that. Also, bond yields on that news, they did rise to their highest level in 3 years, and that was impactful. I'll share with you what areas were hit with that. And then also, there were further sanctions against Russia, both from the US and Europe, that did drive price action in select commodity areas. And China is still continuing to hit record cases of COVID, and the impact there is certainly reduced energy consumption, but also other consumption areas as well with China's huge economy. So that was out there. Also, we did see defensive sectors in the broader markets post the biggest gains. So let's go ahead and take a look at those broader markets, see where did we close the week. We'll start here with the daily price chart of the S&P 500. And a couple of things to key in on here. This is the pullback that we experienced certainly in the second half of the week. And we can see that the broader markets did close at the the level was at 4496, and the 50-day moving average is at 4427. So we were certainly able to close above that. The 200-day at 4492. So we did eke out a close above that 200-day simple moving average. The relevance here is we want the broader markets to be finding support above these key moving averages to give us a sense of security, if you will, that the broader market, certainly the S&P, remains in a rather cautious but positive stance. So outside momentum indicators here, the RSI did close above that 50 in positive territory. Then we have the faster moving stochastics, another momentum indicator, and that is negative. So a bit mixed as it relates to the broader markets, but from here, I'd be remiss in not sharing with you a daily price chart of the Nasdaq. The Nasdaq was down quite a bit this week. I talked about the concept of growth stocks being impacted by this higher interest rate environment. So here we are with the daily price chart of the Nasdaq, and we can see it really fell out of bed, down 3.6%. That's relative to the S&P that was down 1%. And in essence, we want to see where this index closed relative to this 50-day simple moving average. So that 50-day, you can use the over here, this area will provide you with the information on where that 50-day is, 13,798. And unfortunately, we did close below that level at 13,711. So unfortunately, as it relates to the Nasdaq, we also have outside momentum indicators that are negative. The RSI and the stochastics are negative. And your next area of downside support is this January low, and that is about almost 6% below this close here. So not particularly looking great for the growthier tech heavy Nasdaq. So from here, let's go ahead and drill down, take a look at some of these underlying sectors. We want to see where the markets as it relates to these individual areas. And this will just take me a second. In fact, I will now share with you how you can very quickly embrace and take a look at these underlying 12 sectors within the S&P 500. So we're looking at a 2-month daily price chart of these sectors. I've gone ahead and added that RSI, that's that relative strength indicator, because we want to see up here in this upper left quartile, where is that relative outperformance within the markets? And then of course, make sure you're not overweighted in these areas that are deteriorating and relatively underperforming. So I talked about this in the beginning. Your defensive areas up here at the forefront. This was the case last week as well. So utilities, staples, healthcare, and real estate, all certainly very defensive, but they are also great hedges against a rising interest rate and a high inflation period. Many of these underlying stocks, not only do they offer high yields, these stocks in these groups do have an ability to raise their prices and pass them along during this high inflationary period. So lots of reasons for these groups to be up here in the forefront. Let's just take a quick look at technology because it was the worst performer for the week, down 3.8%. We'll get into where that weakness really was in our next segment here, but you can see it has broken below all of these areas of support. So tech really over the near term in trouble. We'll talk more with Danielle about that and get her read on the technology as well as some of these other sectors. But from here, let's go ahead and move on, take a look at some of the underlying sub industry groupings. And from my work, I like to keep in mind where is the yield on that 10-year because this is an area that was very impacted by the news that the Federal Reserve was going to be a bit more aggressive in their rate hike policy, as well as their reducing of their balance sheet. They're not going to be executing bond buying, and actually, more supply of bonds does increase interest rates. So, from here, let's take a look at an industry group that was normally would be positive in a rising rate environment, but it did not fare well. And this is bank stocks, regional banks. KRE is the ticker symbol, and we can see what's taking place. The reason for this is because while long-term yields are rising, shorter-term yields are rising higher. That is an inverted yield curve, not constructive for these bank stocks. And this is a big fertile area as it relates to earnings next week. I talked about earnings season starting, and a number of very high profile banks are due to report. So we'll be keeping an eye on certainly the outlook for that. Also up here in the forefront is IHI. This is the medical products, and I've been talking about this group because it has such an ability to outperform when it can get going. So we are continuing to see the potential downtrend reversal here. This is a daily chart. If we can get above this 200-day, that would be ideal, but there certainly are bright spots in that sub industry grouping. And then from here, we can just take a quick look. I like to share with you where the volatility index ended. And it is still elevated. We ended at 21. From my work, anything above that 18 is indicating uncertainty among investors. It's certainly off of its peak, but still quite high. One other area I did want to share with you that really took it on the chin last week is the semiconductor index, SOXX. And semiconductor stocks were down 7, almost 8% for the week. And this is something I talked about in my MEM Edge report last Sunday, when this area first started to deteriorate, and it was all about Wall Street analysts and their outlooks for demand, for chip demand going into next year. And it really did begin this wave of selling in the semiconductor space. And in turn, of course, that is a heavyweight area in the Nasdaq. So, and also the technology area. And really, that is it as it relates to the markets and digging in. We're going to take a brief break here, and we'll be right back. Hi, this is Mary Ellen McGonagle, author of the MEM Edge Report. In my biweekly report, I highlight top growth stocks as they enter buy zones, and I educate subscribers on why that stock is attractive both technically and fundamentally. In addition, you'll be alerted to when it's time to exit that stock based on negative technical action. And this biweekly report gives you confidence by providing fundamental insights into why an area of the market is strong and which companies within that strong area have the best growth profiles that'll help propel that stock higher. Subscribers to the MEM Edge Report are benefiting from my expertise in uncovering top performing growth stocks. Subscribe now to take advantage of my special trial offer. And we are back, as mentioned, very special guest here today. This is Danielle Shay, and she's the VP of options at Simpler Trading. So very, very excited. What we are going to be doing here is taking a look at some of these companies that are due to report earnings. We can also look maybe at some companies that have reported, and it's going to be all about how you can use options to maximize and capitalize on any potential moves in these names. So welcome, Danielle. Great to have you.
Great. It's great to be here, Mary Ellen. I always love working with you. So I'm looking forward to talking through some of these different tickers that are going to be really in focus in the next few weeks.
Yeah, in fact, you have UNH up there. The company's due to report on Thursday. And I think what we're seeing is analysts are beginning to revise estimates going into earnings. I believe that's the case with UNH, but the stock rallied 6.6% ahead of next Thursday's report. What would you potentially do with this, or maybe it's out of reach?
So, when I'm looking at earnings from an options perspective, I really like to trade quick moves going into earnings and then also just trade the overnight move themselves. United Healthcare is a really good example of one that's definitely too late to get into a swing trade, obviously, since, you have earnings coming up and like you noted, it already rallied 6%. But one of the trades that I do really like to do in the options market is find these kind of strong tickers in strong sectors. And I like to get in prior to earnings and then ride that move higher. Now, last quarter, we had a pretty weak earnings season. We didn't see a lot of bullish anticipation going into earnings. But for the most part, on these relative strength names, I like to look for them to trade higher going into the earnings report. Now, since we're already up on the report itself, personally, for me, I first of all would look at what they've done on previous quarters. Now, these bubbles right here, this demonstrates how much the price gapped overnight upon the earnings report. So basically, when you're looking at United Healthcare, it demonstrates that usually an after earnings move can be anywhere between 0.7% and 5.5%. Now that's just over the course of the last 4 quarters. And the majority of the time they move higher post earnings. Also, they've beat earnings the last 4 out of 4 quarters. So, typically a bullish stock. Now, the problem with it is it's all obviously, all the way up here, pretty extended. So, for me in the options market, even though it's a strong stock, I do think it's a better bet to look for it to revert back to the mean post earnings, even though I will say the statistics are largely bullish on it.
And what charting service is this? Is this?
This is Thinkorswim, and
Mhm.
then this is a custom tool that I have created called the
Oh,
Earnings
wow.
Hot Zone.
I
Yeah, so
love it.
thank you.
Wow.
It gives me a lot of different statistics and data, and basically what I'm looking for is I'm looking for how has the company actually done on earnings? Because I mean, we can definitely look at EPS, which is important. But what I really like to look for is the investor reaction, both after earnings and then before earnings. So these different colored screens, what they do is they demonstrate if the ticker traded higher, flat, or lower within that time frame. So when I'm looking at an earnings report, I want to know, okay, does this stock normally trade higher going into earnings? The first screen is going to be a 21 bar time frame prior to earnings. The second one is going to be an 8-day bar prior to earnings, and the third one is post earnings. So you can easily see, what the ticker normally does, and then that's what gives me kind of a bit of statistics to make a
And the
trade.
confidence, right. And
Yeah.
I think forgive me, I'm not, this would be available to people that are Think or Swim subscribers. Is that right? They'd be able to.
So this is a custom proprietary indicator. So we do have it available in our simpler trading store. But yes, it definitely is available for Thinkorswim members. If you purchase it in our simpler trading store.
Mhm. Wow, I love it. Okay, now I can't wait to see some of these other names. Did you have any that you wanted to share that are coming up over the next couple of weeks here?
Sure. I mean, the number one focus that I have going into next week is really going to be the banks. And I mean, I know you're pretty focused on the banks as well. And
Mhm.
I think that one for me, I mean, when I'm looking at the earnings statistics and I look at the last 5 quarters, I can see that JPMorgan has been soft post earnings for the last 5 quarters in a row.
Wow.
Yeah. And when you also look at last quarter in particular, I mean, they really suffered last quarter when it gapped down 4.4% overnight. And this move in JP Morgan was pretty critical because that's really the move that shifted it into an overall downtrend. And that day was also let's see, January 14th. That day was also the day where the indexes just really started to break down. So
Right, right.
so
Yeah.
I'm highly focused on that. What do you think about bank earnings going into next week?
Yeah, no, great question. So the other catalyst there I remember Jamie Dimon is the CEO of JPM, and it was all about the increased cost going forward into this year and next for these bank stocks, not just as it relates to employee retention, increased labor costs, but also technologically and hiring new people to develop new proprietary products for themselves. So the increased costs going forward, they actually guided lower their estimates. And I think that was one of the key drivers for the broader markets. JPM was not the only bank. Goldman Sachs as well came out actually the next day. And that was a big gap down on that name as well. They're due out next Thursday. And that was another company that also cited similar increased cost and uh, really was the beginning. And it just really highlights how impactful earnings are as it relates to not only shifts with industries, but in this case, the overall market.
Oh, absolutely. And I mean, I think that, for me personally, I do enjoy trading earnings reports overnight. And I know a lot of people don't, but I always tell any of my subscribers, anyone who's wanting to learn about the markets, is that even if you don't want to trade the actual report, having a really good feel for, what could potentially be coming because it may have a big impact on your portfolio, I think is really important. So I know that's probably a main reason why you like to highlight earnings season as well, because
Oh,
otherwise,
big catalyst. Yeah.
it's a major catalyst. And I mean, I,
Mhm.
I do think that there's I think there's one saving grace here, just in the fact that because these executives did guide lower and they did note all of the headwinds last quarter. I mean, it's possible that because that's priced in, that their earnings might be better than expected. Um, but this
Yeah,
is
I think
just,
this
what do you
inverted,
think?
yeah, well, the yield curve is not favorable, certainly for those smaller banks where they incur a lot of their profit margins from lending activity. And the current way that interest rates are rising in the shorter term is not positive for them. Of course, these money center banks are a little bit different in the fact that they have trading revenue and JPMorgan with their credit card. So you might see a bit of an offset, but I'm not particularly favorable or thinking favorably of them, but they are so oversold that we may see a bounce on any hint of non-negative news. So yeah, I think it'll be really interesting. I thought we could take maybe a quick look at PSMT. They came out with their numbers and the stock really catapulted. It was up 10%. And in turn, PriceSmart, for those of you not familiar, it is a big box discount retailer. And we did see Costco and some of the other big box names rally in tandem with this big move. So interesting because they saw their membership hit an all-time high, which in turn really propelled the stock higher.
I like that pick. I haven't looked at this chart before, so I'm really glad that you bring this one up because, I mean, definitely in this overall environment, I mean, people are looking for ways to save money, and these big box retailers, I mean, it makes so much sense. So, I mean, I like the reversal off of the lows. Definitely, I think last quarter, and this is something that I really like to look at as far as the earnings reaction is there were companies last quarter, even when, the whole market was basically falling apart, they'd report earnings and then they gap up 4%. Now, I know that obviously this was in a downtrend and it gapped up and it rolled, but it came back. And I mean, I think that this is a great example of a company that, initially upon the report, the reaction was good. And for me, I have seen those kind of companies, the ones that are really strengthening up right now because they've been able to, keep going in light of the inflationary environment and supply chain shortages and everything else. I like Tractor Supply here too for that same
Oh
reason.
yeah, let's take a look at that. And
So, oh, sorry, what were you going to say?
we did a show earlier, actually last month, and you highlighted Costco as one of your top picks, and that's done well. But that's a side note to the PSMT trade. But yeah, let's look at yeah.
Well, and Costco, I like to think of Tractor Supply. So I live in rural Texas and I never had ever been to a Tractor Supply in my life, never knew what it was. And now, I'm out here in rural Texas and I discovered, Tractor Supply is basically the Costco for rural America. Okay. So
Wow.
I was on this Costco train and I thought, okay, the main reason why I did like Costco when I think was it in January that we talked
I
about this?
think it was
Probably
last month, I believe,
February,
in March,
March. Yeah, I
right
mean,
there.
right here. Yeah. So, I mean, I really liked this consolidation in Costco, but I mean, again, this is another example of something that I was following because of earnings, because it had even though these were small moves, I mean, Costco is not something that, I mean, it's not Tesla, right? It's not going to be up 10% in a day. But what I liked about it was that it's been trading relatively higher going into earnings. And I also really like the fact that they have been beating earnings in this overall market environment and they've still noted continuous growth. And so when I was thinking about, hey, Costco's is a good long pick in this market environment, that is what got me onto Tractor Supply.
Love it.
Yeah, so I think that
So you do all your shopping here now?
well, it's crazy because I have 3 bunnies and I've been buying they're very cute. But they're very expensive, shockingly. They
Oh, I
eat a
didn't know that.
lot. I know they eat a lot. And so
Oh
I've been
my.
buying their food on Amazon until I discovered Tractor Supply, and it's like a third of the price there.
Oh,
So
wow.
yeah. So um
And they're due to report soon.
yes, and you know what was crazy about this one was I had wanted to get into it down here because I like to make buys around the 50 simple on the daily chart, which is this yellow line right here on my charts. But then there was actually some news yesterday that they were getting a, what was it? It was a electric powered lawnmowers.
Oh, no.
Yes. And so it kind of exploded.
Oh,
So I
my.
didn't get the great entry at the 50 simple that I wanted, but yeah, they are going to be having, let's see, Greenworks Pro battery operated outdoor power equipment. So I don't know.
Wow.
Apparently that
That's
was
exciting.
yeah. So that was the catalyst. So I mean, there's not a ton of room left to run on this one. I would target maybe 250 or 260, but I still think it's a good ticker to point out in this overall
I
market
think
environment.
it looks great because it's a hair away from a 1 month base breakout, and they are due in 2 weeks' time to report their numbers. So, yeah, we'll be keeping an eye on that one.
Awesome. Excellent. I'm glad that you like it. I thought
Yeah,
that might align with what you were looking at.
sure, sure. And if you had any others that are due to report, by all means,
Well, let's
because yeah,
see.
it's been interesting in the sense that uh, some companies are going up in price, even though they're not really their earnings. They're disappointing in their outlook. After this, maybe we can look at STZ as an example. But let's take a look at Netflix.
Sure. So one thing that I do think that investors should be really aware of in this market environment is that, throughout 2020, I mean, it didn't matter what a company was reporting. I mean, it just honestly didn't, right? We just had such a momentum market, all the new IPOs, just so much hype and excitement, so many new investors into the market. But what I think has been the most important factor over the course of this year has been the fact that so many of these stocks just got pumped up to absolutely ridiculous numbers. And earnings is really what is sticking the final fork in them. And so when you look at Netflix, for example, this is looking at it over the course of the last 2 years, they've only beat estimates 3 out of the last 8 quarters, which is a pretty poor showing. And then they have multiple quarters in a row where they're gapping down on the report, which just,
Oh my.
to me, says investors are not happy with what was reported, right? And
Yeah.
then for me, what this leads to is a setup that I like to call earnings destruction. So when you notice that you have a company that was one of those very hyped up tickers throughout 2020, COVID name, and then you can see that it's not doing very well on earnings. And then what happens is all of a sudden everybody starts to care a lot what their earnings report says, and it just rolls over and dies. And so I think it is important for investors to be paying attention to the companies they have in their portfolio, because if they've been weak on earnings recently, they absolutely have the potential to drop down 20% overnight.
Oh my goodness. That is so fantastic. We are actually, unfortunately, out of time, but we will be keeping an eye on Netflix and any number of these names. And I did want to very quickly mention that Danielle does have an incredible mastery course that digs more into this. And it's really critical during this earnings period. There is an ability for you to trial that. There's going to be a link below, and I highly suggest that you do that, staying on top of these names and using this powerful system. So great to have you, Danielle.
Excellent. It was great to join you. Thanks for having me.
Oh, of course. Till next week, guys. Take care.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.